more, I'm now joined by David Savir, co-founder and CEO of Element Pointe Advisors. David, hi. Let's talk then about this PMI data today. It's the latest in a series of data points that seem to be pointing towards the US already being in a slowdown. So what do you think? Are we already seeing that slowdown that could decrease inflation?
Hi, Elena. Thank you for having me. Nice to be back with you. Yeah, the PMI data this morning was certainly surprising, particularly the low reading in the services sector. 70% of US GDP is services sector GDP, and the majority of Americans work in the services sector. So seeing that decline from nearly 53 in the prior month's reading to 47 was certainly significant. And we do think it indicates that we are already in the start of a slowdown. And it remains to be seen how rapidly that slowdown and the deterioration occurs. Obviously, that's going to impact the path of Fed tightening. And as Chair Powell has said on a number of occasions, he's attempting to orchestrate a quote unquote soft landing. That is, in our view, very challenging to accomplish. Although certainly the slowdown in economic data that we're seeing indicates to us that the gradual path toward declining growth is already here.
You say that soft landing is very challenging to accomplish. Why exactly do you think the Fed won't put it off?
Yeah, so the Fed has been able to achieve a soft landing in the past. It's occurred in 1965, 1984, and 1994, but those were economic backdrops that were very different from the present environment. In none of those scenarios did we have inflation over a 5% rate. And now, of course, we're dealing with a CPI reading that came in above 9 most recently. PCE readings are expected to be quite high for June as well when those numbers are final. And it's just a much more extreme scenario in terms of the need to curb inflation and tighten monetary conditions. And while I'm hopeful that a soft landing can be accomplished, I think that the likelihood is against there being a soft landing. In our view, there's a greater likelihood of a recession within the next 12 months, likely starting at the start of 2023. Technically, by the popular definition of recession, which is 2 consecutive quarters of negative GDP growth, we're already there. Although worth noting that that's not actually how the National Bureau of Economic Research defines recession. They have a much broader definition that takes into account production levels and employment levels. And so by that definition, we're not yet in a recession, but we think that all indications are pointing in the direction of our being there probably at some point within the next 12 months.
Do you think, though, that these growing signs of a slowdown will change the tone of the Fed's conversation at next week's meeting, or are we still going to hear that inflation is the overriding priority?
I think that inflation will remain the overriding priority. It's very interesting to note that when we look at past hiking cycles, not since 1970 has the Fed ever maintained a Fed funds rate post-hiking at a level that was below the inflation rate. So when we consider where we are today, the Fed has indicated that it would end the year probably at a Fed funds rate in the neighborhood of 3.4%. The likelihood that the inflation rate will be lower than 3.4% by year end is in our view quite low. So what's very interesting is even if it halted the hiking cycle at or near that level, and Fed funds futures markets have recently priced in the assumption that Fed funds rate would peak at around Q1 of 23 at around 3.6%, and then there would be a rate cutting cycle after that. What's interesting is that that would likely mean that the Fed funds hiking cycle would end at a lower rate than the rate of inflation, which has not happened since 1970.
Wow, thank you for that insight, David Savir, co-founder and CEO of Element Pointe Advisors.